Okay, good afternoon everybody. I think it's about time to start. So I'd like to introduce myself. My name's Steve Ruffley, and I'm from Intertrader. I'm going to be taking this webinar tonight. We're going to be talking about cash and risk management. So again, if you watch my previous presentation on psychology, something that wasn't well known and perhaps a bit of an insider's trick or an insider's way of getting edge on trading, cash management is very well known. We should all have our risk strategies and understand what we're doing when we're trading and why. So before I start, I need to read a risk warning. Now, spread betting and CFD trading both carry a high level of risk to your capital with the possibility of losing more than your initial investment. These products may not be suitable for all investors and are only intended for people of the age of 18. Please ensure you're fully aware of the risks involved and, if necessary, seek independent financial advice. Okay, this is educational only. Right, the content of the webinar is the personal opinion of the moderator and not Intertrader.com. The content does not constitute financial, investment or tax advice. You're advised to discuss your specific requirements with an independent financial advisor prior to entering any bet. Intertrader.com is not responsible and disclaims all and any liability for the content or comments during this session. Alright guys, as we said, tonight, this evening's seminar is going to be all about an introduction to risk and cash management. So really, this is one of the main keys to success. And again, I've managed some of the biggest traders in the world. That when people get into a losing situation, the whole mindset changes. And instead of listening to the rules, being objective, saying maybe my opinion's wrong or there's some new fundamental news in the market, it's like, no, I'm going to hold on to this because I know I'm right and I'm going to take all the pain that's involved and I'm going to hold this trade. Okay? Now the disciplined trader, what do you want to be? Do you want to be that or do you want to be a rogue trader? So the ultimate aim in trading is to make money. So I'm telling that if you're disciplined, you stick to your rules, and again, the rules that you're going to set that suit your trading style, that trade your attitude to risk, and also the amount you trade and the amount of money you have on deposit. So if you can balance all these things together and be disciplined, I can show you techniques and I can show you ways that over the long run you're going to be a more successful trader. So a simple statement. If you don't look to make more money and be profitable in trades than losing trades, in the long run, you are doomed to failure. Now again, as I was saying to you before, I've managed a lot of traders in the past, and I've been guilty of it myself. I've held on for a loss much further than I thought. Now the simple reason for this, I'm just like you, and other big traders, fundamentally are just like you. Nobody likes taking a trade for a loss. Nobody likes seeing a trade go offside, see the red, see the negative in their account, and then have to press the button to get out. Doesn't matter who you are, nobody likes it. Now there's different reasons why people hold on to unsuccessful or losing trades. And number one is just the fear. Okay? Pressing the button and realizing that loss, taking that capital away from yourself, giving the money back to the market, nobody likes it. So the fear keeps you in. Now another reason is poor rules. So how many times in your trading career have you said, okay, I'm going to trade on this ratio, so that means after my entry point, I'm going to get out a 15 tick offside position. Yeah, no matter what, I'm going to get out. And then before you know it, you're right on that 15 tick stop, and you pull your stop and you let it go another 5 ticks, then it goes another 10 ticks, and it's like, oh, you have to get out. So you just cost yourself another extra 10 ticks for no reason. Yeah, you've had your rule set in, and for whatever reason, the fear that maybe you just didn't want to realize that loss. You didn't take the loss, and you've cost yourself nearly twice your stop. Okay, another reason why people can get into losing situations is they're not aware of the fundamental news. So they haven't got the news wires open. They're not watching, Sky News or CNBC or Bloomberg. Maybe they've not listened to the squawk. Right now in the markets, it's absolutely imperative that we have, real-time information. All these services are out there, so we should know when the economic figures are coming out. We should know our key speakers, especially when people like Jean-Claude Trichet or Ben Bernanke or other people, policymakers, are speaking over the wires. Very, very important we listen to what they say, because this can change the direction of the markets very, very rapidly. Okay, number 4 is really that sometimes people just have the wrong opinion. We're all guilty of it. There's nothing wrong with it. Sometimes we just call the market wrong. And that's just a fact of trading. You're not always going to get it right. I know this, and hopefully you guys know it. But what I'd say is, being one of the most powerful things about being a trader is if you can identify when you're not trading well and stop, or you can identify when you're wrong. Usually, again, as with the psychology, there's certain factors that keep coming up. There's certain things that, you say to yourself in your head, or maybe mannerisms you keep, or maybe, just little things that you know yourself that basically tell you the trade is wrong or you're not confident. And as soon as you hear, feel these things or you can recognize them patterns, then just get out. Save yourself some money. The markets aren't going anywhere. There will always be other opportunities in that day or that trading session or that period to make some money. So when you do, identify these things that, making you lose trades or not have the confidence to stay in a trade, then it's really important that you get out as quickly as you can and preserve your capital. Because again, that's what trading's all about, using what you have on deposit to go out into the market and invest and buy and sell and increase that capital that you have. Because when we talk about trading, your capital is king. And, it's your currency in the markets. And the less of that you have, the less often you can trade and the less size you can trade. So you've really got to protect that at all times. I can't stress that enough. So what is risk management? Well, really it's the same as cash management. Okay? Again, when we talk about, trading circles and we talk about, the common language, traders especially like to make things, a little bit more aloof, a little bit more complicated, and it's not. A lot of things I do, because I've done it for such a long time, I've taught so many people, is I try and use as little jargon as I can. Now we have to be aware of the terms like hawkish and dovish, bullish and bearish, all them kind of things. But really what we can do when we're just doing our own trading plan and doing our own risk management, we talk to ourselves in the language we can understand. So we talk about risk management and ratios. It's all about, well, how much money am I going to put on this trade and how much money do I have in the bank? Can I afford to do that trade? So again, it's just making it, in our language, simple for us to understand. So when we do put our rules in place, that we know we understand them and then we stick to them. We have no reason for not sticking to these rules, and we can't, we're not going to cheat ourselves. So again, it makes it a lot more powerful and it makes you, stick to your rules because of your rules. Okay, so when I say capital's king, capital by its very definition is the most important asset you're going to have in trading. Okay, because it gives you confidence and it also facilitates when and how much you can trade. So this isn't like betting. Okay, so when we talk about spread betting, sometimes, I don't like using that term because it implies that we're betting, and we're not. We're taking a calculated risk based on, fundamental and technical analysis and our views and the way we envisage the market's going to move. So again, we're not going to put a £5 bet on, a horse, at the local race course at 5-1 for £5, and when it loses, we'll lose our £5. With trading, as we know, that, if it goes offside and we're at a £5 trade, every single time this goes a tick against us, it's costing us another £5. So it's very, very different from betting. Now another key point to try and get across is that the markets don't care who you are. I mean, we're all sat behind a PC, we may have, 2 screens, 4 screens, whatever, but we're just one person behind a screen. So the market can't see you. It doesn't know who you are, how long you've been trading, how much money you've got. It doesn't know anything, and it doesn't care. So what you can do is take a step back and act like a pro, even if you're a novice, because no one else has to know. If you start putting rules in place, and you stick to your rules and your cash management, and you have a trading plan and a trading log, well, I tell you, you're already more professional than most of the traders I used to work with. So that's a fact. So again, begin as you mean to go on. Very easy to throw your rules out the window when things are going well. It's a whole different ball game when things are going badly. You have to, when things aren't going so well, or you're not trading well or making the money you should do, you need to be able to go back to your rules and take confidence from this, reassess, identify patterns where you've been going wrong, identifying patterns where you're going right, and then stick to them. Okay? So there's 4 simple rules we can stick to, and we're going to come to that a little bit later on. But you can really break it down to these steps and identify a part of each one of these steps and make that part of your trading plan, of the way you trade the markets, the way you approach it. Now, the third point is a big one for me, is you've got to avoid excuses at all costs. Nobody cares. Right? Sorry to be harsh. The market doesn't care and nobody else cares. Not you, maybe the people that, are relying on you for money might care. But, your friends down the pub or, other traders in the market, etc., etc., they don't care. So if you've got a trade wrong, you've got to take it on the chin, pick yourself up, identify why it went wrong, and then continue in the markets. So you have to, don't lie to yourself ever. Be very, very honest and open. If you did a bad trade, there's nothing wrong with that, okay? We're all going to do bad trades and we're going to have losing trades, but what we need to do is box them off and then identify when they're bad, forget about them, and move on with the good trades. Right, the next point is the market is not against you. Very, very easy, and I'm sure we've all sat there, I know I have, and every time I got in the market went against me. The second I pressed the button. Now it happens to us all, but remember, as I said to you before, the market's not against you, the market is just doing what it does. It's just other traders. So don't ever take it personally. And the last point is, just like anything else in life, except you're not going to get the market right all the time. It just won't happen. We're trading in probabilities, and we're trading the probable likelihood that we'll have more winners than losers. Okay? So there will be an element of losers in your trading career, be it a day, a week, a session, whatever. There will always be a point where you're going to lose. Accept that right now, and you save yourself a lot of heartache. Trust me. So when I say there's 4 rules, or there's 4 steps to trading, I kind of break it down. So you've got your cash and risk management, but the things that give you the confidence and, are going to give you the boundaries of how you make these rules and how you manage your cash and how you manage your risk. I mean, you can really identify in these 4 steps. So number 1 is your preparation. Now, I won't go on too much about it, but I cannot stress to you how important preparation is. Okay? Not just from a physical way to trade and, be able to understand what's going on, but for your mental strength and your confidence. Preparation is absolutely key. Okay? Now number 2 is your entry level. Number 3 is your target level. And number 4 is your stop level. So again, all very simple things we should have heard of, and all things we should probably imply at every point during a trading session or a trade. So preparation. Now, you can't just log on and trade. Now, it's not to say that I'm telling you can't. Of course you can. You're the trader. You've got the power. You can do anything you like. But in my experience, if you can just spend 10-15 minutes before you trade or before a session, you're going to be better prepared. You're going to be better ready, to know where your levels are, to kind of check out what's happening in the markets and be able to react quicker. I've seen it, and I've done it so many times that you have to take my word for it. That if you do a little bit of preparation, even if it's only 5 minutes, it's gonna set you in a better stead for the rest of that session than not. So you've got to look at things like, what have the currency pairs done overnight? If you come in the morning, you've got to look at the currencies. If you don't trade FX, it's quite easy for people just to discount FX as being a separate type of product. Well, I trade the indices or the bond markets. Currency trades $4 trillion every single day. That makes it important. Yep, because if people are looking at it, it's going to have an effect on the markets. So check what the currency pairs have done overnight. Check overnight news. Now again, very important at the minute, what's happening in the US. If you're trading the UK session, what's happening in the US, the Asian markets. And then a bit of quick analysis. Did it move the markets like you expected? Is this priced in, or is this an unexpected move? Very, very important at this point. What data's coming out? Have you checked your economic calendar? Do we know who's speaking? Do we know what big figures are out? So again, what do they say? What do you say? What's expected? Read some of the commentators, read the FT, read the New York Times, whatever you read, just try and get, a feel for what the market's thinking, what its attitude is, because that's who you're trading against, other people that have read these things. And if you're not on the same page, then how are you going to trade with them? How are you going to go with the momentum and get it right? Yeah? So again, just practical tips, things, that hopefully you all already do, or you're aware of doing. And if you're trading technically, you should be aware of your levels. Maybe you've got, weekly levels or daily levels. Are they going to come in range in this trading session? Okay? Things like that. Things that you're building it up. I did briefly listen to one of the other speakers, and he was saying that he uses 2 hours an hour. That's a good tip. But maybe, go a little bit further. Use daily levels and then break that down into hourlies. See if you can see any correlations. Then maybe break it down into 15 minutes. So you trade off 15-minute entry and exit points, but from levels that you've made from weeklies, dailies, hourlies. Again, the longer the time frame, the stronger the trend is going to be, the more it's going to hold up. Okay? And again, if we're starting trading on a Monday, there's a real value in weekend analysis. Okay? That's going to be the next slide. Now, weekend analysis is very, very important because, firstly, the markets are closed. So that means nobody can do anything. Right? So Friday afternoon, we generally see busy in the mornings and it tails off in the afternoon because traders tend to finish early and go down the pub. So that's, that's why the markets are quiet on a Friday afternoon. But also, we can see volatility because people get out of positions, long or short, on a Friday afternoon because they don't want to hold it over the weekend. Yeah? Because something could happen over the weekend that could shift the markets in either direction. So generally this would be your fundamental things. Maybe something bad like an earthquake, or maybe something good like an emergency meeting where they cut interest rates. All these kind of things. But if the markets are closed, you're powerless, there's nothing you can do. So what we can do is use the weekend to review the whole trading activity in the whole past week. We're not running overnight positions. So, we've got a fresh perspective. We can look at everything that's happened over the last week, analyze it, put that into our trading plan, then bang, when Monday comes, we're ready. What also we can do is we can, plan for the week ahead. We can get our, our calendar up. We can look at central bank speeches, things that might, again, come out that's going to affect the market in a fundamental way. So any kind of figures. Then we can kind of, try and build up an opinion. So again, you're always going to trade better if you've got some sort of opinion. If it's based on something. You've got some reason why you are getting involved because you believe X, Y, and Z. And what we can do as well is put a bit of a slider scale of importance on things like figures and speakers and days. Some days, if there's nothing out, it might be difficult to trade because there's no direction in the market. So maybe, we don't trade that day. We'll leave it out. Maybe we'll look for a day, maybe last Friday, for instance, non-farm payrolls. I held a live trading seminar. We're all talking about it, very excited. The range was about 59 to 60,000. Bang! It comes out over 100,000. I've not seen a figure out of line for some time. And again, a great trading session. We had a good hour of trading where there was bags of opportunities to trade, and we made good money. So again, if we'd have not traded all week and maybe not took any losers or maybe small profits, but then bang, Friday comes, we're confident because we've had no losses. We know we've got all our capital to play with. I made around about £1,500. So that's not a bad trading day, to be honest. It's not a bad trading week, just off one figure. So again, these are the things you need to look at and prepare and, build your trading plan around. So entry levels. Now, depending on your style, it can be difficult to get your entry points. And a lot of people say to me, that, Steve, where do I put my stops? And, what ratio should I be using, risk reward? Now, again, it all depends on your trading style. So you're either going to be a more position trader, where you have to have a wider stop level, or you're going to be a scalper. So you're looking for 1 or 2 or 3 tick moves in the market and take some quick profit. So again, you have to know what kind of trader you are, and then put your risk strategy against this. So you can't just swap between, I would say, in my opinion, being a position trader and a scalper, because then again, you're going to get your rules and your levels and your stop levels confused, and it's going to become too complicated. When it comes to trading, you need to stick to what works for you and what's going to produce the best results. So if you give yourself a 10 tick stop and like 7 or 8 trades out of 10 you win, then why try and be a scalper when you just lose 2 ticks every trade? Yeah? So again, it's all the things you need to do to get the edge. So think about what the market might do. Again, remember, the daily ranges are very important at the minute. When the markets used to move 2 or 3, 4, 5% in a day, it was massive. So, these days it's not such a big deal. So if you're trying to make 20 ticks out of a move, maybe you're underselling yourself. Maybe that move really is a 40, 50 tick move because of the volatility. So make sure you know how far the markets can move, because that'll allow you to get out for a bigger profit while also being able to manage the right kind of risk, because there's no point trying to make 50 ticks on a 1 tick stop. Yeah? So it's things like that you need to look at. And again, remember, 80% of the time, markets, when they have a big move, are going to retrace about 50% of the initial move. So you don't have to chase it. Now, again, absolutely perfect example on Friday's live trading session. The figure came out, a lot of volatility, bang! We saw a big green 5-minute candle, as I said, and that came back to about 60% on the next candle, where people sold off and got profit. Then the market went double again, upwards. So remember, even if you missed the first move, look for the retracement, profit taking, and use that as an entry point. Okay? That's another good tip to use. Your entry point should always be, if you're going to buy, above the moving average or sell below the moving average. These are things that are going to make it better and give you more solid entry points, doing little things like this. The target levels. So again, when you get into that trade, rule number 1 is you have to know where you're going to get out. Are you looking for a 10, 15, 20, 30, 40 tick move? Have some target, have some point of attraction, whether it be Fibonacci level, whether it be, a strong technical level, or maybe you just want to make 30 ticks. Whatever, it doesn't matter. As long as you've got that in your mind, you've got somewhere to aim for. Okay, so is the market, trying to identify, is the market primed for a big move, or is it a sucker move? Is it trying to catch people in? Another key point when you're talking about target levels, be realistic, yeah? Don't be greedy. If you've caught the back of a correct move and it's going your way, then look for your point to get out of that you set. Maybe get a little bit out and try and run some more. Or, again, play with the position, but don't, when it's 56 on side, just expect it to go 100. Because the likelihood is, if you don't stick to your rules, you're going to get caught out. Alright? And you're going to end up taking less profit than you deserve. So the market will often push further than you think. Again, and you might think that you've missed out on potential profits. But, again, you have to look at it that you've stuck to your rules, so really you're a winner doubly. You're a winner because you took some profit, and you're a winner because you stuck to your rules. It won't always happen that the move continues. Okay? And again, when it comes to the classic excuse of not taking profit, or, stopping yourself out, and you say to yourself, well, I wish I'd done that, or believe me, it's one of these things. Hindsight is a great thing, especially in trading, but you've only got yourself to blame. If you put a rule in place and you don't stick to it, then there's no point having the rule in the first place. And again, you're the trader. These are your rules. I'm just telling you from the benefit of my experience what's going to make you, in the long run, a more successful trader. So again, take what you will from these sessions and take the bits that apply to you and you think you need to work on and take them away. And then again, hopefully they work for you. Again, I'm just telling you, all the things I've done, I've been taught, and these are the things that work for me. See stop level. Now, this is a big one really. It should really be our first rule. Because again, if you know where you need to get out, then again, you've already won. So what I'd say is don't look at it when you get stopped out that you've lost. Again, look at it that you've paid for the information. You've paid for the information that particular trade at that time was wrong. So you've taken your stop out, you've taken your hit on the money, but it's okay. You stuck to your rules. In some ways you're a winner. I'm not going to say, that's the easiest way to look at it, but if you do, it's going to help your mental state. Trust me. If you can treat winners and losers the same, you're going to become a very, very powerful trader. So again, it's easy to look at the market and have an opinion. But, what if you're wrong? You have to think to yourself, where am I getting out at all times? Yeah, even if you're getting out for a profit. Because, the markets are so volatile and move so quick. You can have profit on the table and not take it. And before you know it, you're taking the trade out for a loss and you don't even know why. So again, always be prepared. So it goes back to preparation. Know when you get into a trade where your stop is, where your exit point is at all times. So again, there's all different things, when we talk about stop levels. Again, we try and take the emotions out of trading by using stops. That's really, why we use stops. Because what they do is they tell us exactly when we get in the trade, exactly what we're prepared to risk and lose. So already, when we put our stop in, the pressure's almost off. That, this is either going to go 20 ticks on side because I'm buying the market, or it's going to come back 10 ticks on the downside against me and stop me out. But that means I lose £50, etc., and I'm willing to make £200 on the upside. So it's not the end of the world. I get stopped out and I'll come back, reassess, and I'll put a different trade on. So again, when you stop yourself out, it's never a happy event. But if you stuck to your rules, and it's your rules, and you've got out for the loss you can manage and you can afford, then really you're a winner. Okay? I'm not going to say it's the easiest thing to swallow and buy, and I'm not trying to, feed you false lines or mumbo jumbo or trader speak. I'm just trying to tell you, from an honest perspective, that if you can stick to your rules, you're going to feel better about taking a loss. And that's just a fact. So okay, that's going to bring us on to risk reward now. So when we talk about risk reward, we've got to really kind of put it in a manageable sense. Now this kind of contradicts what I said, unfortunately, about betting. But a good analogy a friend of mine told me is that if we want to talk about risk reward and how we look at it, we can look at it in betting terms. So if you've got a £10 bet and I come to you and say, alright, I've got a dead cert horse, it's 10 to 1. You think to yourself, well, I'll tell you what, a 10 to 1 is guaranteed to win. Yeah, £10 I'll take that bet, no problem at all. In fact, I'll put more. But then I've come back to you and say, actually it's 3 to 1. It's not 10 to 1 anymore. Oh, okay, well it's not as exciting, but yeah, I'd still have a go. And then, I finally come back to you and say, well actually it's gone to 1 to 3. So you're going to put £3 on to win £1 back. Well, that's hardly exciting at all, is it, for a dead cert? So when you look at trading, then why would you do the same thing? Okay, so if you're going to trade and look to make £1,000, why would you stop loss with £3,000? Why would you risk £3,000 to make £1,000? Doesn't make any sense. So you need to flip that round and make sure that you're always on the positive side. That if you're going to risk £1,000 of your hard-earned money, you should be looking to make £2,000 or £3,000 from that risk. So £1,000 is a good chunk of money. So again, it's all back down to risk reward. We don't want to be risking more than the potential reward is. It just doesn't make any sense. So again, it's one of the basic mistakes novice traders don't make. And it's because they haven't decided beforehand. They haven't got the rules in place. They haven't thought about it. Just get involved in the market. The trade goes offside. It's not going well for them. It's like, well, I've got £3,000 in my account, so that's what I can afford to lose. Wrong. Oh, utter nonsense. If you've got £3,000 in your trading account, you don't be, really kind of risking more than £300-400 in a trade. Tops. So that's the way we have to look at it, and that's how you protect your capital. If you go into the attitude that I've got £3,000 to play with, that £3,000 will be gone in 3 trades. That's just the way trading is. So we've got to break it down into manageable chunks. For that particular trade, I'm willing to risk this % of my capital, which is X ticks or X amount of pounds. Okay? That's how we want to look at it. So we're not punters, yeah? We're not to say I've got £50 after I've been paid and I can blow it all, yeah? Our currency is our capital, and we need to protect it at all times. So each bet or each time we trade is just as important as the next, because that should have some sort of correlation in terms of to how much capital you have in deposit. So people, again, always ask me, Steve, what's the correct risk reward? And I find it very difficult to answer, because there's so many different factors. Again, how much money we have in deposit, our attitude to risk, what type of trader, how experienced, the market conditions. I could go on. But I'd have to say, as a rule of thumb, you want to be looking for a minimum risk reward of 2 to 1. So if you're going to risk £1,000 in this example, you want to be making £2,000. You don't want to be risking £1,000 to make £10. You don't want to risk £1,000 to make £100. You need to be making, I'd say, double what you're staking. So if you put that into, trading terms, if you're trying to make a 60 tick profit out of a move, then you need, your stop loss needs to be around 20, 30 pips in your entry. Okay? And that, that works out as a simple formula. And that's how you're going to be able to calculate what you're going to make. So again, it depends how you look at the markets. Some people don't like looking in monetary values, because they find it puts them off. It never bothered me, to be honest. But then some people like watching tick values. So again, very much like casinos and things that try to fool you, it's only a pip, it's only 1 tick. Well, it's not. It's still really money at the end of the day. But again, it's whatever works for you. If you want to look at it from a money perspective or a ticks perspective, it's entirely up to you. Whatever works for you, that's what we have to do. Now again, when I was a very young trader, I found it very difficult to kind of put a monetary value on. So I might walk in one morning and, make £2,000, for instance, say. Very easy then to go home flat at the end of the day and, you've not traded well, stuck to your rewards, you've lost £2,000. Now when you think to yourself, that could have bought, 2, 3 sets of nice golf clubs. Sometimes you have to look at trading and the money involved as physical things, get some perspective on it. Because when we start talking about numbers and thousands of pounds, etc., sometimes we can lose our edge, lose our perspective. But if we try and put some reality into it, and try and mirror it back to real life, then maybe it's going to, slightly change the way we view it. And when we are on side, take some profit. When we've had a good trading session and we've made the money, bank it. Because it's real. It's not just some imaginary money on the web. This is real physical money. So that's another tip, I've used over the years to try and make people a little bit more realistic. That when you've got money on the table, take it. When you've got a loss on your books, take it quicker. Because the longer you hold it, the more you're going to have to pay up in the end, generally speaking. So why beginners lose money? Now, why beginners lose money is because we said at the beginning, they run into deeper losses than winning trades. Now, it might sound completely illogical, but it happens a lot more often than you think. So I've seen people, again, this is a real example, people go around 100 pips offside and take a 20 pip profit. Because he's relieved, he's glad not to be, to be able to realise all that loss. And after all that, he's actually made some profit. That's a result, that's a winning trade. No, it's not. That's a terrible trade. Because what will have happened is he'll have took all that pain on, he'll have got out of, for a 20 tick profit, and then it will have gone 200 ticks on side. But he's taken all that risk, all that 100 ticks worth of pain to make 20 pips. Ridiculous. So again, these are the things that can get you into bad, how can I say, kind of bad scenarios or, bad ways of trading, bad habits, should I say. So never let a trade go that far offside that it's too big to even take out. You can't possibly take it out, so you hold on to it because there's no other option. Yeah. If we're into that territory, it's very, very dangerous. So again, even professional traders, are going to take on more risk than they perhaps, bargained for. But again, if you're kind of sensible about it and it's not too much risk, and you've got some factors like, well, some economic data's come out, or there's been, some fundamental news or something shifting the market. As long as you can justify it in some way, then you're going to be able to, again, justify changing your risk reward in the middle of a trade. Otherwise, the rules are there for a reason. Stick to them. Okay? Now, if you stick to your risk reward and you stick to your rules, yeah, you're going to become a much better trader, a much more powerful trader. Now, I know this for a fact because I've been one, I am one, and I've taught lots of traders. Okay? The more you stick to these rules, and the more, again, not regimented, because I don't want to take the fun out of it or the enjoyment out of it, but the more you kind of stick to a basic plan, the better you're going to do in the long run. Yeah, and I just know it, because I've just experienced it so many times. So why are you stops? Now, stops serve a number of purposes. Okay, number one, primarily, they protect your capital. So if the market's, doing exaggerated moves, or they're moving very volatilely, up and down the range, yeah, you're going to get stopped out, so you're not going to take extra risk on. So again, another very powerful reason for using a stop is, as we've said before, you're going to know how much you're going to lose, or you're risking, yeah, before you're right. So as soon as you put that stop in, you've said to yourself, well, I'm guaranteed that I'm either going to make a profit of what I think, or some profit, or I'm going to risk and lose X amount. So again, it takes a bit of the fear out of the trade. Now again, sometimes the markets can move a lot quicker than you think. I mean, a lot of people, I myself have been guilty of this, not putting stops in. And, some bit of fundamental news coming out, or the market's blipping, as we call it, and I've had to take a big loss, and I've not known why. If you don't put stops in, then you can't get automatically stopped out if the market starts to go aggressively against you, and you don't know why. So again, it's just another safety mechanism, to allow you to lock in, your risk parameters, should I say. And again, stops are another thing, if you get stopped out, it's a common thing that happens. It allows you to give you a breather, it's an automatic thing. Okay, the trade's not right, it's gone against you, you've been stopped out, fine, no problem at all. I'm going to have a cup of tea, I'm going to read some charts, read some news, I've been stopped out, no problem. It was manageable, it's what I could afford, I'll just go on and do another trade. Excuses. Now again, as I said to you before, something you need to avoid like the plague. Okay? So, one of the classic ones I've heard over the years, many, many years, it's, I got stopped out and the market went exactly where I thought it was going. Okay? I can translate this into, my entry level was wrong, and I misjudged where the market might go first. Or, I placed the right position, but I was taking on too much risk, it was too big for me, so I had to get out for a loss. Yep, that's what that excuse means. Yep. If you knew where the market was going, you wouldn't have lost money. It's really, really simple. So again, I don't want to make too light of it, but, don't try and lie to yourself. Make sure you take on positions that you can manage, they're the right kind of size, and again, time your entry point that matches with your stop levels. Okay? So the art of trading is just judging where the market go before it hits your target. So you've always got to adjust your entry size and your entry level. Because again, remember, if the trade's going right, you can always positively average in, buy more into the trade or sell more into the trade. Yeah? Once it's going in your direction, it becomes that little bit easier. It's just that all the bits before that are the hard parts. So real kind of conclusion. The risk management is the art of balancing profit. So again, it's all managing your expectations against your manageable losses. So again, the word manageable always has to be in there. So you always have to know that what your capital is, what you can stake per trade, and again, what you're willing to lose on that trade, and how it's going to affect your future trading career. I mean, again, if you take on too much risk, then, you can stop your trading career for maybe a week, maybe a month, who knows, until you can get that money back some other way. So again, don't go into the market and expect to get it right all the time. Okay, it's just not going to happen. And again, the more prepared you are to take on reasonable risk and then get out for your rules when you are wrong, in the long term, again, the more powerful you're going to be. So when you do take losses, again, always make sure that they're smaller than the profits you take, otherwise you're just not going to make it. So again, if you try and make 7 out of 10 winning trades, you're on the right tracks and you're going to do well. Okay? So you're not going to survive if them other 3 trades are huge losses. Okay? It's just very, very basics of cash management and looking after your capital. So again, if you don't make more with your winners than you do with your losers, you're doomed to failure. But, again, the good point is that when we take it away from this seminar, if you keep your stops small and in place, you're going to do fine. If you try and make more on your winners than your losses, you're going to do fine. If you make your rules, I can help you with that if you need, and you stick to your rules, you're going to be fine. Trust me. Again, there's a lot of money in the markets to be made, especially right now, a lot of money. And if you can control your entry points and your downside risk, the money's there to be taken. Okay? My live trading sessions have proved it. 6 out of 7 live trading sessions, I'm up money. And again, good money. So, all different things to play for. Alright guys, well that's pretty much the end of the presentation on cash and risk management. Have you got any questions on the subject? Any thoughts? Anything anyone would like to ask? Okay, Buki, I said you can lose more that's in your account. Can you explain? Yeah, I can explain, obviously. That's more referring to my professional trading days where it's like almost like a bank. You have an overdraft, you know, you can lose more that's in your account. So obviously for you guys, if you're trading on a spread betting account, unless you've got a credit line, you wouldn't be able to do that. So that's how that's explained. Yeah, sorry, that was just using a different term than how I used to trade in spread betting. What do I trade? Well, I trade anything and everything, to be honest. I'm generally indices, the DAX, the FTSE, the S&P, but I can trade anything. Alright, James. 80% of the time, markets will trade 50% of the initial move. Are you referring to the major FX pairs? Yeah, I mean, again, I should really have had some charts to show you, but again, if you go back to the non-farm payroll, when that came out, if you put it in a 5-minute time frame, you'll see that the first initial bar is a solid green bar, and then it didn't come 50%, to be honest, it came about 60% back. Now, this is just, again, that you can't take these figures, and you can't, you know, even though I'm a trading professional, I've traded for years, I can't give you exact figures. Now, when I say 80% of the time, markets will trade 50% of the time, okay? Now, that's like saying any kind of statistics. I can prove anything you want with statistics. But all I'm saying is that after every sustained solid bar move, there will be the next bar, or the bar after that will be some sort of retracement from the initial point. Yeah? Because people take profit. So 80% of the time, should I say, there will be a retracement, okay, of a percent. I might not be able to say 50%, but there will certainly be a retracement. Okay, Rob, you have a problem when market transitions to trend, okay? I tend to continue picking tops or bottoms, hits me hard. Any tips? Yeah, if you pick bottoms, you get smelly fingers, an old trading term. Right, and the market's always going to trend in 3 ways, yeah? Bullish, bearish, or sideways. It's all about picking the direction of the market. So what I'd say to you is, if you're trying to pick trends, and you know, they're going against you and you're getting broke through, what you need to do is perhaps look at the overall trend, okay? So look at your hourlies or your dailies and look at the bigger picture. Okay, now there'll always be little side trends in the overall trend. Okay, so your best thing to do is that, again, if you get stopped out because, you know, you're picking good bottoms or good tops and breaking through, you're using things like your indicators, your oscillators. Use things like, you know, your moving average, Bollinger Bands, that will show you the probable top or bottom of the market. And then tie this in with your indicators like your MACD, your volume and your strength indicators. Because if it's looking weak when it's coming to the top of the level on the upside, it probably won't break through. But if it's looking strong as it's going on the upside, it will break through. If it's looking weak, it will not break through. So these are the things you need to do to back up the overall trend. Look at your strength and your oscillators that will tell you if there's momentum enough to break through that level on the upside or downside. Okay? So I hope that's helped you, Rob. A very good question, by the way. James, it's a damn risky time to trade non-farm payroll. That's the name of the game, James. You know, it's a risky business. But again, we're trying to take as much risk out as we can, and approach it in a structured, responsible manner. And if we do, you know, I didn't take a lot of risk on, to be honest, and I made some good money. It's not always that way, but when non-farm payroll comes out at over 100, it's expected at 60, you buy them stocks, my friend. You know, there's only one way it's going to go, and that's up. Okay, Isaac, what is strategy on range trending? Range trending, okay, well, it's very, very simple, to be honest. I actually do a seminar on trend trading. It's very, very powerful. You pick the bottom end and the top end. So you draw, you know, your 45-degree lines in on the top of the graph and the bottom of the graph, where the trend is. And again, try and pick 3, 4, 5 points where it hits this line. Draw your midpoint line in. Yep. So when it goes towards the bottom of the trend, you buy to the midpoint and wait for it to go to the top. It's at the top of the trend. Yep. You sell to the midpoint, wait for something to happen. If it breaks through, fine. If it doesn't, take your profit. So that's the simple way of trading in a range. But again, as I said to Rob, try and tie this in with an oscillator. Yeah, because when they do break out, you need to know where the strength is going to come into the market, where the volume is. So I mean, again, that's how you trade a range. Pick a top point, a bottom point, and a midpoint, and only trade in the extremes of the top and the bottom. Yep. Your initial target point is the midpoint. So if you're selling to the midpoint down, if you're buying to the midpoint up, that's how you trade a range. Trying trader, okay, how do you work out your position size in monetary value, not lot size, as some brokers don't like place trade? Well, again, I mean, it's just a percentage. I mean, again, lot or pips or ticks, whatever you want to call them, that's what they are. They're just monetary value. So if you're trading the FTSE and it's £7.50 a lot, that's what a lot is. It's £7.50. So you just work out what it is per lot, times it by your risk, and that's what you're putting in the market. You say, I want to sell £1,000 worth of FTSE, and to the nearest point or pip, they'll give you it. So that's how you do that. Alright guys, some good questions here. I'm enjoying this. Anything else you'd like to ask? Anything about the markets? Anything on, risk strategies? How about you tell me what your risk strategies are? Has anyone got anything, any ratios they, use and have found has worked for them? Okay, Ray. Well, again, I appreciate the comments. Very, very, very kind of you. But again, I mean, these sessions are meant to be for people, of all trading abilities. Even a professional trader, you can pick things out of them. Again, I'm very kind of wary that I don't know what people's levels are, so I try and make them, as kind of far-ranging as I can. I mean, funnily enough, I'm just finishing a presentation, a whole series for InterTrader called How to Trade for a Living. Now, this is the building blocks of trading. So this is 10 points on how you can become a professional trader. So this goes into a lot more detail, and these are the things that I learned, and I can tell you, if you follow, 1 point of each of these 10 and put it into your trading plan, you're going to be a lot better trader. So again, that's a bit more complicated, a bit more in depth. So, have a look around. These are things, you can get involved in. Yeah, absolutely, Ray. Yeah, no, it's a very, very good point, yeah. Again, I mean, unlike the psychology in my previous seminar where people might not be aware of it, I think everyone should be aware of risk and, that they know when they put money in the betting money or the staking money, there is a risk involved. But it's not, it's letting people have the power again, empowering them. There's rules to stick to and there's ways of managing risk and taking the fear out of it. Trading doesn't have to or ever be scary. If you know what you've got to play with and you put some sensible rules in, then, you're taking some risk out of the market and you take some risk out of, of what you're doing. Do I have any blogs, you can follow? Yeah, again, I mean, the best way really is just to go through, see the stuff on InterTrader, they have, squawks and live updates. There are different ways you can follow me. If you Google Trader Maker, for instance, or you find Trader Maker on Facebook, there's some different things that I put out into the market via their mediums. Alright guys, anything else you'd like to ask this evening? I think we've hopefully still got a little bit of time. Okay, do I have any advice on adding to winning trades? Yes, I do have some advice actually. Adding to winning trades is something that people don't do enough of. Okay, what we call that is positively averaging in trading terms. What I'd say to you is, again, another principle. If you've identified a trend, so again, if you're trading within a range, for instance, so you've bought at the bottom, the market's trading at the midpoint, maybe you see a bit of a sell-off, okay, with some profit taking. At that point, if the next bar doesn't close below that bar, then you can buy at that point and look to go to the top end of the range. So always look for the bar after the one that closes. So look for things like inside bars, yeah? So an inside bar is where it closes inside the previous bar. And if the next bar opens above the low of that bar, then that's a point you can buy at and positively average and get more out of the trade. Okay? So I do a presentation on that. Again, it's quite a lengthy thing. I have examples. I can show you practical examples, but that's one way of doing it. Look at the previous bar. Okay, Vince, how many trades do I put at the same time or hedge? To be honest, I very rarely hedge, Vince, to be honest. But for the example of trading non-farm payroll, I had all my, again, another good tip, I had all my markets open. I had all the sizes I wanted to trade in their markets, and I knew I could afford to put them all on because I had the same, I had the, enough capital. And when the figure came out, I bought all the stocks I had open. So I didn't have to mess around, changing prices or trying to buy more. I just bought everything, every stock market. So that's another tip. So I never hedge, but I always have markets open so I can hit it quickly and be the first in the move. Okay, see my question above. Okay. Do I prefer trending or ranging markets? I don't care. I will trade any market. It doesn't make any difference to me. As long as I identify what the trade is, what the trend is, I'll trade it. So it doesn't make any difference to me. There's equal money to be made out of both of them. Maybe what I say, sometimes when markets are really breaking out and directional, I prefer that to trending. But no, it doesn't make any difference to me. I'm quite market neutral. I'll take an opinion for what the market's telling me. So I'll go long if the market's going long. I'll go short if the market's going short. Don't be fooled by these counter trend traders that tell you can make more money. It's nonsense. Right, the trend's your friend, go with the trend. Because you're going with momentum and you're going to points of attraction. So go with the trend, my friends, always. I did not mention if I traded Forex. I have traded Forex, yeah. I've traded some Euro-dollar. Again, I'm a professional trader. I can trade whatever I like, to be honest. So if the markets and the Forex are moving a lot and they look interesting, I'll get involved. If they're not, then I won't. Okay, Isaac, great question. Again, look at your market. If you're trading the US markets, look at the Euro-dollar. Look at the dollar-yen. So do 2 or 3 that are relevant to your market. You don't have to look at all the currency pairs. You can do there forever. So just, again, with all analysis, do what's relevant to your trade and to your market. Okay, good question, this must. What type of order do I use? Stop do I use? A market limit. I always use limit orders, to be honest. But I don't really use stops that often, if I'm being very, very honest. Again, going against my own rules. But again, I've been doing it a long time. I'm a professional trader, so I like having the freedom of averaging in. See, I'll generally take a bigger position in negative and positive average, so I don't use stops. But I'd recommend you use limit orders. But again, whatever works for you. But very, very good question, that. Very good question. Yes, I have held trades over the weekend. I held the non-farm payroll trade over the weekend. But no, as a rule of thanks, a rule of thumb, should I say, I don't generally tend to hold trades overnight. I'm generally an intraday trader. But again, it just depends, it depends how the market dictates. If I think it's going to be strong and I think I'm right, I stay in. But that's where the confidence comes in, you see. That's where your planning comes in. And that years and years of expensive training I've had. No, I never use scanners or any kind of things like that. What I'll do is I'm quite methodical. I'll open a daily chart. I'll see the highs and lows of the previous day. I'll see the overall trend. And again, I'll get an opinion. I'll start to trade when the market reaches my opinion. So I don't wait for anybody else to tell me when to trade. I don't listen to, people saying that, we'll buy gold now, it's going to go 50 pips. It's just nonsense. What I do is I look at the market objectively, and then I put my rules in place, and then I trade around my rules. So that's how I do it. But again, you've got to find whatever works for you. But great question. But use anything that works for you in general. But again, there's no quick wins. There's no easy things to do in trading. There's no gurus. No matter what people say, there's only you against the market and your rules and your capital. Okay. Do I scalp? Yeah. Sometimes I scalp. Yeah. And sometimes I hold them. Again, it just depends on the market. What the market dictates. Great question, Isaac. Yeah, very difficult, this one. Yeah, if there's big, major news, you've got to trade straight away, because that's where you're going to get, as a trader, your most money. But, there's been times where big events have come out and I've waited, maybe only 5-10 minutes, but you wait for it to filter through the market, and then you see the volume momentum come into the market, and then you ride the wave. So, again, it just depends how big the news is. And again, most non-farm payrolls, because, you don't always get filled, I'll wait 5 minutes and then trade. But this non-farm payroll, I just traded straight after because it was so far out of line. But again, this is where your rules come in. Okay, good question, Joe. It's a difficult one. This again, I hear a lot that, people say, I got stopped out and I was actually right overall. If you're right overall, then maybe look at widening your stops or putting your stops further out so you don't get stopped out. Okay? Or maybe try getting in at a different position. Because, there are certain moves that if they're right, so it shouldn't really be taking you out of the trade. But if you have got taken out and it starts to go back in your favour, yeah, don't ever be afraid of getting back in. But again, it just depends on how you trade and what your rules are. Okay, Market Timer, am I a technical or fundamental trader? I'm a bit of both, to be honest, I like trading fundamental news when it comes out, and when it's trading technically, if there is no news, I adapt to that style. Again, I think you have to be a bit of, a little bit of both. If you're a fundamental trader, then you can't be trading unless there's a figure out, some news out, or something big in the market. If you're a technical trader, you have to be aware of the news, but only trading around your levels. So it all depends how frequently you want to trade and what your attitude to risk and your reward is. Right. Where am I based in the UK? I'm not based in the UK. I'm offshore. I'm in Europe somewhere. Okay, Trader X, how do you maintain discipline in trading? Do you need a plan, a goal, a journal? You need all these things. Absolutely, you need all these things. Great question. You need a journal to be able to assess what you did over that week, because you never remember every trade. Maybe you'll figure out you're a morning trader. Maybe you'll figure you're an afternoon trader. Little things like that. If you don't record it, you'll never know. If you don't have a plan, you're planning to fail. Very famous quote. So you need a plan, some basic risks. So these are the things you need to have in that are going to really let you maintain discipline. You don't just, you learn discipline, but you have to have some rules. Alright guys, so there's some great questions there. I think it's been a really good session. Again, this is recorded, so you'll be able to hear it. If you want to see any more of my other webinars, you can, again, come on through InterTrader. I think we're coming to the end of it now. I'm getting the beeps. So, this is recorded, so if you want to go back and re-listen to it, that'd be great. Alright guys, happy trading, and I wish you a good night. Cheers guys.